A couple of questions. You talked about how you've got a strong balance sheet, $205 million in cash and bullion, but you also spoke to a lot of the time, effort, and money spent on greenfield exploration. Unlike the other gold companies I've been speaking to, M&A is not forming part of your growth strategy moving forward?
Oh, look, it does, and I didn't touch on it because I think it's taken as it's a bit of a taken for granted that you do it, and we're looking. It does form part of our growth strategy, but I think and we're no different from anybody else on that front. We're looking for value. We're looking to make sure that we're not overpaying. But I think part of the key message in this for the people that have come along to listen is to get them to understand the things that I can talk about in detail, which is internally. Because our business, we're not relying on M&A for growth. It forms part of the options that we're looking at, but we've got some great growth opportunities within our own operations, and that's kind of what I wanted to emphasise during this morning session.
And you're generating strong cash flows, and that's expected to continue for the foreseeable future?
Yeah, it is. Yeah, we certainly. There's a bit of a change this year from the last couple of years. We're still low-cost producers, relatively low-cost producers. But we're spending a little bit money. We have to spend a little bit of money up front setting up the underground at Rosemont. So we're seeing that having an impact and on our costs. We do. There's about 3 or 4 months of commercial production coming from the underground this year, and because it's the very early stages and it's from the area that's the lower grade than the average, the costs from underground are a little bit higher. Certainly, they're higher than the average. So basically, simple maths tells us the further we get on, that those costs will come down. And we're also doing more stripping for our pits. And what we see is over the next 2 or 3 years, or next 2 years, that will continue to be the case, and then our stripping ratio really starts to drop off. So I see this year as being a little bit of setting ourselves up. While we've still got excellent margins, particularly with the current gold price, we're setting ourselves up for some really good performances coming down the pipeline at us.
Jim, EIS for McPhilly is out from memory. How, given the history of opposition to the project in the region and around Bathurst, and I know you're going to be taking water from the old colliery, but still in the middle of a drought. I mean, how easy do you expect this to go in terms of both community relations and the state government approval process?
Yeah, good question, Nick. Look, what we've done today, just to clarify, we've put in our development application, which includes the EIS. So you're right, but that is yet to be released. So the department looks at that. They sort of have a look at it and see whether they've got, from their point of view, whether we've provided everything that they think. Sometimes they're happy with it. Sometimes they want us to add a little bit more information here and there. So we're in that stage at the moment. Then it'll go out for public viewing, and then after that, people put their comments in, and then the process really kicks off. So that's where we're at. In terms of the different views in the community about our project, and there are, there are. And that's understandable. That's change is something that has an impact on a lot of people, and some people feel that it's negative, whereas others see the benefits of it. So we've got to keep informing the community as to what we're really doing, not what the perception is that we're doing. There is a strong perception of what we're going to do, yet which at times can vary quite a bit from what we actually are going to do. So I think the first step for us is to make sure that we've been able to provide the information and the background to people so that they understand what we're really doing and start to allow the perception to be, less cultivated and more realistic.
Just within it, part of some of the historic issues around the opposition to that were because I think the original plan was to take wastewater from Bathurst, effectively the community viewed it as taken out of the river system. That problem. How much of that do you think still lingers in perception in terms of what people think you're doing rather than what you're actually doing?
Yeah, look, I think, well, the short answer to that is I'd like to think that the community knows what we're doing because we've been explaining it. We had a number of open, what we call open days, where we basically set up a whole series of information booths within the town hall, and we get out there and we talk to people. We're certainly not taking water from Bathurst or from any river system. You know, we actually think, and we're working on what we think is a pretty, I don't know whether elegant's the right word, but it seems to be a good opportunity for us to bring the water from a place where there's an excess of it, and it sort of ticks a couple of boxes. So, you know, it means that the people in Blaney and the immediate area knows that there's an operation that's starting up that's basically looking after itself for water. Thank you very much. You know, and we go from there. They you know, so and again, that's part of what I think the job that we've got ahead of us, to make sure that people understand the full and clear picture of what we're there and what we're going to be doing.
Sorry, Jim. I just wanted to get your opinion on the current gold price and where you think it might be heading.
But yeah, I don't know.
Do you think it's going to keep going higher?
Depends who's reaching for their tweet. Don't quote me on that. This is not live.
My question is like,
There's a little red dot appearing on my forehead already.
So you don't agree they should put a statue of Trump up next to Paddy Hammond?
Yeah. Look, I don't know. I mean, you know, the gold is the go-to value. Well, it's not the go-to, but it certainly strengthens in times of uncertainty, and we're in times of uncertainty. You know, there's a lot going on, and therefore I think that's a bit of a driver. Certainly, I mean, I wouldn't profess to be any kind of expert on what drives gold price, but I've always viewed it as being, it's, you know, the more uncertain, the better it is for gold.
will you be hedging? I noticed you've got quite a few hedging contracts. Will you be hedging any further production at certain prices, or are you looking just to take advantage of the current?
Look, I think for us, we view hedging as a bit of risk management. But having said that, we've got 450,000 odd ounces hedged at an average. I think it's about $1,610 an ounce, and it's actually it's a bit bipolar's not the right word, but there's two major. We've got a couple of 100,000 ounces that are hedged between 1,400 and 1,500. We're just focusing at the moment on dribbling those out. 10,000 ounces a quarter. It's not a huge rate. At that rate, it has a pretty minimal impact on our overall revenue. Would we add some more? Look, we're looking at it and trying to decide whether building or maintaining our hedge book is the right thing to do. I think hedging certainly has a role to play if you've got major capital expenditure and you need to cover the risk. But right now we don't. So that's an element of that decision-making process that doesn't come into it.
Is there a case for buying back some of that book?
I don't know. I'm not. If you buy it back, you crystallise the loss, right? And some of our, I'd like to think that you're in two states of mind with hedging. That's in a position. You'd like to think that. If we hang, because it represents a little bit more than 10% of our reserves. So, and they're spot deferred, so we can actually kick them down the road. These aren't, and this is a key thing that's different for Regis for other hedge books. Other folks have got, there's 10,000 ounces here at X price, and you've got to sell into it. We don't. We've had them there for quite a while, and we've been able to kick them down the road. Look, we've taken a view that, in effect, we do want to buy them out by selling into them, but not all in one go. And, a little bit discretionary that we can, if it goes really good and we think that the gold price has gone up, there's a spike, we sort of, we work on that, but we'll just dribble them out and slowly lift our average, which we've already been doing, stuff that it wasn't, it was it's been happening for a while, just in slow volumes.
Do you wish you'd bought something when you had $500 million at Mount Gibson?
Yeah.
Sorry, cheap shot.
Those were the days.
I did have another McPhillips one, but I've lost it now. Sorry.
I'll go.
You go.
Jim, if you could talk about gold sector more broadly, do you think there's room for more consolidation, particularly in that mid-tier space that you guys sit in?
Well, it depends on who you talk. Yes and no. I mean, yes, if there's value for all shareholders. There's a lot of consolidation went on a decade ago, and some people won, in inverted commas, and some people lost. And certainly the message that having been away from gold for a while and coming back into it, spending a little bit of time earlier this year talking to some of the North American investors, there was a pretty clear message that, they don't want to see repeats of the huge margins that were paid, the huge premiums that were paid to create big organisations, and then, we all know what happened subsequent to that as a sort of thing, because gold price is volatile. So we're always wary of that. Then the other side of that is that there are those that are arguing that the gold specialists are tending to shrink in size, and it's going to these more general funds, and therefore you need to be big to be relevant. I don't know. I suppose I'm a little bit. I don't ascribe to any of them really. I just look to figure out what's the best way for us to make value for our shareholders. If you start to become just part of a general metric, people want to get into gold and want to get out of gold. It's like some funds you don't understand why they come in, you don't understand why they come out. It's exciting when they're all coming in, and then it's a little bit heartbreaking when they're all going out. But there's nothing that you've done really. It's just the way the prices move. So, we will look for M&A opportunities where we see it being sensible. We might see value where others don't. It's going to be important that if that is the case, that we enunciate that very clearly, and we need to make sure we keep our egos and our desires in check. We've got to do things for the right reason, not because bigger is better.
Cost inflation. Having been an iron ore executive during the boom, I still remember the comment you made coming out of that when costs are coming off, that it was more important to get tons out the door. I mean, are you seeing, again, you're competing particularly for development, sort of construction stuff, people are again starting to compete with the iron ore majors, and I mean, the Rio iron ore boss was on the analyst call last week and basically said the reason we problems at Brockman is we couldn't fill the trucks. I mean, are you starting to see that in gold?
No, we've seen we're seeing cost pressures in areas. For example, when the Aussie dollar goes down, that makes all the spare parts for all your imported gear expensive. So while you're gaining on the gold price, it's almost a natural that you can hold your breath and stamp your feet and do whatever you can. That's just going to go up. Fuel moves around a bit. Labour there's a little bit more pressure on labour, so we are seeing some pressures in WA. I think we'll probably see a little bit more pressure in New South Wales on capital construction, because there's a lot of activity going on there. We've got the East Coast and the West Coast, got different things driving it. And when the gold price is high, the temptation is to start to push through. All of a sudden, low grade, which was out of the money, now becomes viable. That in its own automatically pushes up your unit cost, because really in surface mining, two things drive your costs: strip ratio and gold grade. Rate per cubic BCM of movement's pretty. It's a fairly competitive market out there, and it might get moved around by different things. But if your strip ratio's 3-to-1 instead of 6-to-1, you're going to be a low-cost producer. And if your ratio's I don't know what but if you look, for example, or if it's 9-1 instead of 6-1, you're going to be more expensive, and then you're relying on your grade. And if you're starting to lower your cut-off grade because the gold price is $2,100, that's naturally just going to drive up your costs without any pressure. So there's a few things that will push all-in sustaining costs around.
And in terms of those labour market tightness, I mean, is this, heavy diesel fitters in a couple of particular skilled areas have been an emerging problem for mining engineers. I mean, that's been sort of a year or two coming, but are you seeing those wage pressures in operating jobs, or is it still really confined
to the technical? Is it confined to the technical area? Look, I think there's just there is a little bit of pressure around, not to the point where we're overly concerned, but it does. When our guidance this year is higher than our actuals last year, and it's a pretty substantial jump initially when you look at it, because it's gone up. The midpoint's gone up by about $130 an ounce, and people automatically, there was a bit of a knee-jerk reaction to that, but in actual fact, some of it's just because all-in sustaining costs is a lot of different things to a lot of different people. It's not an accounting, it's not audited, and we've now doing a lot more mining in a type of waste movement that counts into all-in sustaining. So that's put pressure on it alone before anything else. We've got this early stage underground, which has added to our costs, which is just part of the sequence of, the first ounces are expensive and later on they'll get cheaper, and on average they'll come out what we thought. And we said about $30 an ounce was actually what we thought, we'd made provisions for salary increases, and we'd made some provisions for CPI rise and falls that we saw as putting pressure on the cost. So, of that overall increase that we saw, actually a reasonably small amount of it was actual cost. The rest of it was really driven by conscious decisions that we'd made, and just by the timing of it. And I would have preferred that mining underground started now, so that over the year we get the benefit of a lower average. But you just rely on that, being able to explain it to people getting it, which they don't always get in the first day or two after you come out. And a week later they go, oh yeah, I get it now. But yeah.
Just wanted to touch on Rosemont quickly. Forgive me if you've already revealed this, but how long are you expecting that operation to last?
How long am I expecting it to last, and how long am I hoping it will last? What I'm expecting it to last is at least 3 years or so. It's about 1.5+ million tonnes. We said we're going to pull out 500,000 tonnes. I mean, the numbers, on our chart here is kind of irrelevant anyway. But we're looking at it for being maybe 3 years. But what we're hoping it will last. If you look at the diagram that we've got in there, and it's hard to pick up on the screen, but there were some pretty impressive intercepts that are down dip of the existing design mine, and they look really good. I can't read them now myself, but they're 3 or 4 metres at 20+ grams per tonne. That's pretty good stuff. Now, does it go bang 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 all the way? No, not yet. But we didn't drill it because we sort of got to the point, and it was a very smart approach to do it, was say we've got enough to prove that we're going to go down there for maybe 3 years. Yep. We get down there, and then life carries on like it has for just about every underground mine that's running now. You get in, you get it started, you got a great platform, you understand the ore body a little bit better, and you keep drilling and you carry on, and before you know it, 10 or 15 years later, you've still got a mine that's only got 2 years of mine life in front of it, but that's what it's had for the last 10 years. So that's what we'd hope for. And certainly all the drilling that we did from the surface to test that continuity was coming up trumps. We just didn't put it up. We just set us up. Well, we could drill this and keep drilling it and get highly confident and start at another 2 years' time, or we could just start now. So we can start now. What's really exciting about Rosemont is we used the high size seismic work and we've got it in one of the other presentations. I didn't put it in today's, but it shows that there's a structure about 1 kilometre down below the surface, and we're interpreting that as being maybe it's the feeder. So we're putting a couple of really deep holes in to see whether we can, a bit of Hail Mary, a couple of Hail Mary holes to see what we find, and they're in progress at the moment. So if that might give us a bit more confidence that we've got the surface area that we've designed up here. We've got a few more holes down here, but if we had one or two holes down here that said, hey, there's a bit of mineralisation down at this point, that'd be really exciting. But we're not there yet. So at the moment, we're only excited about the holes that we've drilled another 200 or 300 metres below the existing development, which is still pretty exciting.
Yep.